thank you as well to our panelists. We're so lucky to have a really strong set of speakers with us today. One thing that Amit shared with us this morning was a reminder, these challenges that we're trying to address collectively are systemic and deeply ingrained in our current financial system. But at the same time, he shared with us this reminder of the power of hope and the tremendous potential of our financial systems if they can really be dedicated to transformative, positive change. And this is the essence of our conversation for the next hour, speaking about how to leverage the power of finance to address the needs of humankind, to address social inequality. And this is why I'm so delighted to have our three speakers today, who I'll briefly introduce. We're joined first by Gustavo Katz Braga. Gustavo, I'll invite you to wave to the group. Gustavo is the Impact Strategy Officer of the Common Fund for Commodities, which is an international financial institution established under the framework of the UN. CFC takes a value chain approach and provides loans to agri-SMEs in developing countries, aiming to really empower those primary producers and contribute to reducing social inequality within and among countries. So we're so glad to have Gustavo joining us. And Gustavo really comes from this perspective of the social and environmental impact of the fund and can pull that into the discussion. We also have Amélie Baudot joining us. Amelie, maybe you can wave to the group as well. Amelie is the Chief Strategy and Legal Officer at the Global Innovation Fund, which is an impact-first investment vehicle funded by the UK, Sweden, US, Australia, and Canada, alongside other philanthropies and corporates. The Global Innovation Fund has invested about $100 million to date in 53 public and private enterprises using a mix of debt, equity, and grants. And so we're really thrilled to have Amelie's perspective sharing how this capital has been deployed and critically how it's been managed to really address some of those systemic inequalities. And then last but certainly not least, we have Steve Buchanan. Steve, I'll also invite you to wave to the group, from Mosaic Capital, which is based in my home state of North Carolina. And Steve is representing Mosaic, which is a private equity fund that seeks to provide business owners and management teams with a differentiated change of control option through employee ownership buyout models. And so we'll be really delighted to unpack what these models look like with the group today. In addition to this, Steve sits on the board of directors for the Best Friends Pet Hotel, Links Global Solutions, and Sayers Technology, and has a host of experience working with companies on a number of fronts. So as you can see, we've got three kind of star speakers, but three very different perspectives, and we'll try to pull that into this discussion. Today we're focused on humankind, and I just want to take one moment before we dig in to reflect on what this really means. Many of you on the line support investees that are doing great work to accelerate progress in addressing inequality, and this is fantastic for so many reasons. But also you yourselves are doing great work to support these companies, and that's really the focus of today's conversation. We want to focus on the choices that you make, how you shape your portfolios, how you support those entrepreneurs, how you structure and exit investments in a way that helps amplify and sustain impact. It's a little bit less of a focus on the work the investees are doing in this conversation, but in no way to diminish their fundamental role. But we really do want to just pull this up to discuss how you as the investor also inform and influence impact. And so over the course of the next hour, we're going to cover the full investment process. We're going to talk about initial strategy selection and investment selection. We'll talk about investment management and non-financial support, and then of course exits. I'm going to talk about how you can shape your capital and shape your relationships to keep impact front and center and to support investees and the communities that you're seeking to benefit, whether that's suppliers and agronomic value chain, if it's employees in the companies that you've invested into, if it's the end clients or customers, and many other different stakeholders. We're covering a lot of ground, and so I'm mindful that we won't be able to go into too much depth on any one piece of this process, but hopefully can really elevate the range of ways that impact can inform each step of decision making. And so with that, it's been enough chatter from me. And so I know we're also eager to hear from those who are really deep in the thick of this work. And so Gustavo, I'm going to invite you to kick us off and share a little bit about how you consider investees and end stakeholders, your suppliers and farmers' needs during that early due diligence phase. And we'll kind of start there and make our way through the investment process over the course of the next half hour or so. And then we'll take time for audience questions as well. So Gustavo, could you share with us a little bit about how you tackle due diligence in a way that incorporates those perspectives?
Yeah, of course. I'll be glad to kickstart the conversation. But before, let me thank you and thank the Jean for the invitation. I'm really glad to be here and say hello to everyone. But yeah, I think this is a good question to start the conversation, and we think it's an important one because at the CFC we really like to engage at the early stages of the investment process with our companies. We believe that during the due diligence phase, it's a great moment when we can be sure that the investment is aligned with our objectives and it's creating social or environmental impact. As Rachel already introduced it, we invest mainly in agri-SMEs, working with smallholder farmers, which in most cases live below the poverty line. So for us, it's important to understand the impact that it's being created for these farmers. But besides the positive, we also want to know and check potential negative impacts. So to properly do that, we have developed our social and environmental management systems. And we did that together with the International Labour Organization. So it was a joint effort. And these systems allow investors to assess the potential risks and also opportunities from the companies they invest in. So we have developed our own specific tools considering the context of our sector and the type of companies we invest in, which are SMEs. So I think we had to adapt for this specific context. And based on these tools, we conduct a social and environmental due diligence, where we try to assess the main social and environmental risks of the investments. And we try to look at 4 main areas when we do that. And these are working conditions, community engagement, resources use and conservation, and pollution prevention. So just to give you some concrete examples on what we assess on this analysis, we check for employment contracts, we check social security contributions, we check pay slip payments, the different policies that the company has. It can be HR policies, any gender-related policies, any license. So we do all these document checks, but we also, of course, go to visit the companies, and there we try to talk to as many stakeholders as possible. So we usually talk to the employees to get their perception, their views, of course, the management, but also to the local communities and the farmers to know how they see their relationship with the companies they are engaged with. And as the result of this assessment, we can determine the risk, the social and environmental risk of the investment. And of course, we share all the findings with the company. And in the end, after discussing these findings with the company, we make a list of recommendations for them. So it can have different layers of these recommendations. So some of the recommendations are conditions that have to be met before we sign a loan agreement with them. some of the conditions can be addressed during the loan period, so are not that urgent. And some of them are just suggestions that can be followed, addressed if they really find suitable. And of course, we try to constantly monitor the progress of these issues along our investment period.
Great. Thank you so much, Gustavo. And it sounds like you've got a really detailed process to capture these perspectives at the outset and begin to provide value add and reflection back to those companies, even at the point of due diligence, which is a fantastic way to kick things off. Amelie, I'd love to turn to you now and hear a little bit about how the Global Innovation Fund engages with its investees as well. And perhaps we'll transition to the post-investment period and hear what that looks like, carrying forward that thread.
Fantastic. Thanks so much. And echoing my thanks as well to be here alongside my distinguished panelists. And thank you to Jin for bringing us together. So we regularly do provide post-investment support like many other early stage investors. And we tend to do that often through seats that we take on investee boards. And we offer post-investment support in areas where we have the expertise and where we can really be additional. And sometimes we go further than the kind of traditional areas of support. So I'd love to just give an example. In 2019, we made a debt and an equity investment into a business called Mr. Green Africa. It's a tech-enabled plastics recycling company that's really seeking to disrupt the informal and exploitative plastics recycling sector in Kenya. Mr. Green offers an in-house end-to-end process for recycling. So it purchases directly from their sourcing agents, who are waste pickers and who are some of society's most marginalized people. Waste pickers working with Mr. Green get better prices, higher income, and safer work. So we provided Mr. Green with support in a variety of areas, including environmental and social and governance support, similar to what Gustavo just spoke about, impact measurement support around data gathering, and governance support through our role on the board. That took the form of regular calls with management, talking through, for example, health and safety policies, safeguarding issues, and adding value to a very strong team, but in areas where we felt like we could be additional. And we hope that these efforts have put Mr. Green in a better position to attract capital, and we've seen that the business is doing very well. But beyond the support, for this case, we're also adding advocacy support to increase awareness and demand for ethically sourced plastics. And we're hoping that more fast-moving consumer goods companies will see the benefits of bringing marginalized sourcing agents to the forefront of ethical supply chains. And the goal is to use Mr. Green as a showcase. It's an incredible business that increases inclusion in some of the most marginalized, as I mentioned. And in order for us to scale impact, we really need to make sure that the industry norms change as well. And that's also part of our post-investment support. I'll stop there.
Great, thank you so much for that. Gustavo, I may actually turn back to you for a moment as well, because I know you've also done a lot of work on that post-investment support phase, and would love to just invite you to share any additional strategies that the CFC is leveraging in that phase to complement some of what Amelie has described.
Yeah, of course, I'd be glad to. So although we are a debt provider and we don't stake equity, we don't own equity stakes on the companies, we do provide long-term capital up to 5 or 7 years. So for us, it's important to build a good relationship with our investees. And we try to make use of our network to support them to grow and help them connecting with relevant partners. So unfortunately, we don't have funds to support technical assistance, but we do have experience on the topic because we manage the technical assistance facility of 2 other impact investment funds active in the agriculture sector. So we learn a lot from this experience, and we try to use what we learn on our investees as well. So just to give you one example, we have a partnership with Katz, which is an organization that provides technical assistance for agro-SMEs that are working with smallholder farmers. And one company from our portfolio has just been approved under this program, and the TA will start soon if it has not started yet, I'm not sure. But this is an avocado oil producer that's based in Kenya, and it currently sources for more than 2,000 organic farmers, the avocados, but now, and then they export the oil and the fresh fruit to Europe and to the USA. And now they want to expand to also export mangoes. So they want to diversify a bit the revenues, and they are receiving the support from CASA for this process. And another example, also in Kenya, it's our partnership with GAIN. GAIN, it's the Global Alliance for Improved Nutrition. So we have another investee there that's a maize aggregator and processor, also sourcing from thousands of smallholder farmers. And we finance a processing plant, a new processing plant for them there. But they wanted to also to diversify and to increase the value addition, and they wanted to produce maize flour. And then we connected this company with GAIN, so they could produce actually a fortified maize flour with nutritious components and they would be targeting this flour to low-income clients. So GAIN provided all the technical assistance for the technical aspects of the nutritious components on the flour. So we connected them, and we see that it was a benefit for both of them. But mostly, yeah, I think that illustrates a bit the kind of relationship we try to build with our investees, because yeah, we are a long-term investment, and we want to see them grow and create more impact.
Thank you so much for that. At this stage, we've talked about the early due diligence, the investment management, and now we're going to shift to looking at the exit phase. And once again, the role that the investor can really play in pulling those community perspectives into the decision making. And so with that, Steve, I'd love to invite you to share a little bit more about Mosaic's model and how you tackle employee ownership and just what that really means. At the same time, I'll invite folks to drop into the chat if you've got any past experience with employee ownership models. We're just kind of curious to get a sense of the global perspectives on that topic as well. But Steve, please take it away.
Well, Rachel, thank you. I'd like to echo my fellow panel members and expressing our appreciation to join you today and talk about something we're very passionate about. So Mosaic Capital Partners is a private equity fund headquartered in the United States, focused on US-based companies. And what we do is that we advocate and promote and create today thousands of new employee owners. We find and identify owners of businesses that have decided they want to sell their business for whatever reasons they may have. And we give them a different alternative than that has been previously in the market. And what this alternative is, we basically say to the owners of these businesses, we will provide you with a fair market value, a competitive value for your business. We will give you a competitive level of cash or liquidity at closing when you sell your business that you could get from other prospective buyers. But we also would add to it this, we think, powerful component that the owners will essentially be selling their companies to their employees. So every buyout transaction that we execute, we call it an employee-owned buyout. The companies will transition and become 100% owned by their employees. And every employee of every one of our portfolio companies has the right to participate in that ownership structure. It is very unique in the United States. We use a legal structure that's called an employee stock ownership plan, an ESOP. That is a defined term in American law. It's been around since the early 70s. So it's a structure that's been around for a long period of time. But unfortunately, if you were to look at the number of active employee-owned businesses in America, that via an ESOP, the number really hasn't changed much in the past 3, 5, 10 years. And we honestly believe that's a travesty. We understand and appreciate and are excited about the power of employee ownership. And the fact that that market hasn't grown, we find troublesome. It really drove the strategy that we have that we deploy today. So we basically function like a private equity fund in the United States. But when we close one of our transactions, our companies then on that day become 100% owned by their employees. We've done this about 12 different times through our first 2 funds. And in all but one case, the owners of those businesses would have never thought or considered selling into an ESOP structure. And so, we believe that we've created incrementally, a couple of thousand employee owners today that would not have existed prior to us being in the marketplace and giving these business owners and their management teams and their various consultants another option when compared and contrasted to selling to a traditional private equity fund or maybe selling to a strategic. And so that is a fundamental tenet of our strategy. We are completely focused 100% on using an ESOP to help us create thousands of new employee owners.
Thank you so much, Steve, for that overview. And I suspect we'll have questions on this front as well. But as you can see already, we're talking about these different strategies that weave in that community, employee, and stakeholder perspective truly from start to finish in a way that's designed to help transform society. And so with that, I'm going to ask one more question, and then we'll open this up to audience questions. And so I'm sure you must have questions on your minds. And again, just invite you to submit those to our questions lead, and we'll have 20-25 minutes or so to dig into those. But perhaps just one more question, Amelie, for you. We've spoken a bit previously about the role that this type of investment strategy can play in really seeding systemic change. And would just love you to reflect a little bit on what that looks like for the Global Innovation Fund's approach too.
Yeah, definitely. And given time constraints, maybe I'll just jump into another example, and happy to answer any questions on it. So at GIF, we're flexible both in the way we design our investments, I can say, and in how we kind of deploy post-investment support. And because we fund innovation, it's particularly critical that we are flexible. Our innovators operating in that early stage are often needing to pivot their business models, et cetera. But this is a slightly kind of different example, and I think also demonstrates kind of the breadth of possibility in this space. So we support private and public innovators. And in this case, we supported a private innovator that was succeeding in providing services to wealthier students in middle income markets, and helped make its services more broadly available to poorer communities. And that required both capital and some kind of unique post-investment support. So the innovator here is called Education Initiatives. It's a for-profit in India that's developed software, an adaptive learning program called MindSpark for classrooms and parents. And MindSpark uses a series of questions to benchmark students and personalize the material so it matches the level of the student. And as I mentioned, MindSpark was being purchased by middle-class parents who could afford it, and in some private schools. And the efficacy of the innovation was proven in that market, but EI had little incentive to break into the larger public school markets because the risks associated with government procurement rules are so high that it makes it it could make it unattractive for a private company. And on the government side, state governments hadn't procured for that kind of software before because they needed evidence that the software would be effective in public schools. So they also had little incentive to kind of embark on a procurement exercise. So this is where we came in, kind of both pre and post investment. We use blended finance as a market making tool to support the entry of EI into the public sector market and to generate the evidence that the government needed to justify procuring the software. And as part of our post investment support, here we had specific expertise there. Our team also worked closely with the government to develop the national procurement guidelines for the software. The funding instrument, just briefly, was pretty innovative as well. We made our funding conditional on EI selling MindSpark to government schools at the marginal cost of the product and at a price schedule that decreased progressively with the increase of students. So it kept the cost from rising substantially And again, it incentivized them to kind of to enter into this new market. They've now deployed MindSpark in 40 government schools in the state of Rajasthan, reaching more than 6,000 children. And they're also providing these services in government schools in 7 other states to reach another 60,000 students. It's at the top of our leaderboard. Importantly, we kind of have a leaderboard of our social impact in terms of measured social impact. And part of that, I think, is the way we've tried to kind of help it seed some systemic change in a market that they weren't operating in before.
Thank you so much, Amelie. And it's so helpful to hear some of these figures around the real impact that's happening on the ground. I'm going to transition to some of our audience questions, and our first one, Steve, is over to you. And in many ways, closely related to this, we're hoping that you could share a little bit more about the impacts, and I'll use this term to include the social impacts and the financial impacts of the model that you've described. And in particular, there's some questions around how you gauge that impact, how you measure the social effects, as well as the profit model or incentive for Mosaic to return ownership to employees. And if you could unpack that a little bit in more detail as well.
Yeah, so if the way by utilizing an employee stock ownership plan, we are providing to all of the employee owners of our respective portfolio companies an incremental retirement benefit. An ESOP is defined in United States law as a retirement benefit. And in terms of how we deploy that, we are basically giving our employees for free an incremental retirement benefit to what may already be in place at the various companies in which we invest. So almost all of our businesses, before we were involved with them, have got something like a 401k or some other sort of profit sharing, a retirement focused benefit. All of those benefits remain in place. We do not adjust any of those or hardly even consider reducing them. But our ESOP, or deployment of our ESOP ownership, gives each and every employee a free incremental benefit around their retirement. And simplistically, the idea behind an ESOP is that we wanted to incent our employees to remain with our businesses for the long term, and also be incented to think like owners and have an appreciation for how impactful how they go about their jobs on a daily basis can be, not only to them, but to their fellow employees. And so it is very easy for us to lay out a financial model that, based on our view of how the company will perform, and our investment period typically is 5 to 5.5 years. So we look at a forecast of what the business, how the business can perform over that 5 to 5.5 year period. We're hopeful that we're going to grow revenues. We're hopefully that we're going to increase profits. We're going to use those cash flows from those profits to both reinvest in our businesses and hopefully pay down some of the debt that we incurred on day one. And those dynamics are going to create equity value. They're going to create value for the employees. And then all of that value is allocated across the entire employee base. And really an interesting dynamic is that every single employee is a beneficiary of this plan. And every single employee is going to get value allocated to them over the life of their employment. And we can model that, and we can forecast that. And typically, if you look across the 12 transactions that we've closed so far, over roughly a 5-year period, we will create an incremental value or benefit for the employee that's going to look like typically 2 to 3 times their annual compensation. So, put that into real numbers. If you were an employee that makes roughly $35,000 a year, over that ensuing 5-year period, you would probably have a benefit that's been allocated to you in your retirement account of over $100,000. And we find that to be very impactful. We find that to be very significant sorry about that, excuse me. The vast majority of our employees are fall into the low to moderate income category as defined here in the States. And many of them, even though a 401k is available to them and there's going to be company matching in that 401k, many of them are simply not able to participate and accumulate retirement savings, despite the fact that those plans are provided by their companies. And so we see this as being a very significant factor. It is a way to create a generational wealth changing event for our employees. And it's very easy for us to calculate that. And indeed, it is a requirement in the United States law that every year the company will have provided by a third party evaluation of the business and evaluation of the account of each and every employee. And so every year an employee is going to get a statement that shows them how many shares they've been allocated and what the shares were worth last year, what the shares are worth now, and gives each and every employee a very real world tangible evidence of the value they're helping create by being dedicated employee owners of their businesses.
Thank you so much, Steve. And it's such a great illustration of that transformation that Amit spoke about earlier today as well. Gustavo, I'll pass over to you with a similar question. We're hoping that you could share a little bit about some of the real world impacts, but also the financial performance associated with your model, and any color you could add there on what that looks like and how your stakeholders react to that too.
Yeah. Regarding impact, we have an impact strategy that we try to follow. So we select the SDG as our main framework, and we have our core SDGs that we think that are more aligned with CFC's mission. And then we mapped the SDGs with some main indicators that we'd like to track to all our project, our investees. And we use that, we do that using the IRIS metrics that are kept by Jim. For those who are not familiar, the IRIS, it's a catalog of online metrics that really helps to standardize what investees are reporting on. So we try to keep track of the main metrics that are important for us, and these include the variation of the income for the farmers after working with the company that we are supporting, and the productivity levels, number of employed created, the value of the wages of these employees, of these jobs created, and also some gender metrics. And we try to understand how these evolve over our investment period. And so these are our main impact metrics. And regarding the financial, we target capital preservation. So we charge interest rates that range between 5 to 10%. So that actually depends of the country we are investing in and the risk of each specific investment. So, but our final target is to keep to achieve the capital preservation.
Great, thank you. Amelie, we have a question for you as well, and hoping that you could share your perspective on how the work of Global Innovation Fund helps to close the pioneers gap. This question in particular, for context, is coming from a social entrepreneur that just recognizes some of the challenges in reaching the track record or size that's suitable for some of this capital, and hoping that you could comment a bit on that.
Of course, and thanks very much for that question. So the whole ethos of GIF is very much on the risk capital side to invest in the pioneer gap, and for innovation in particular. I think we see that we do recognize that there are sometimes trade-offs between financial and social return in the early years, and we're very focused on impact first. And we have seen the need for entrepreneurs or innovators in the pioneer gap for patient concessional capital that isn't that helps them build businesses to get to the place where they can take on. For us, I think the next bridge is probably closer to development finance capital, and then later on commercial capital. So I think GIF very much recognizes that there is a pioneer gap, and that capital like ours is really necessary to fund in that gap, and that it's also quite large. We've seen in the last 5 years of investing that some businesses are starting to scale, but they're still not quite ready to take on higher investors that have a much lower risk tolerance and require higher returns, but they're not necessarily a great source for our scarcer grant capital as well. GIF is purely funded by government grants alongside philanthropies and corporates. So we're actually in the process of raising a new vehicle to sit a little bit later stage in the gap than we are, that will have take on returnable capital from investors, but at levels of return that still allow us to take on the risk and provide the patient concessional capital, and sometimes capital in local currency, et cetera, that innovators and entrepreneurs need in the pioneer gap. And I'm happy to provide more information to the question asker as well offline.
Thank you so much for that, Amelie. That's really, really clear and helpful. One more question that's come up is just around how your respective models have evolved and changed over time. And I'd love to invite Gustavo and Steve, both of you, to comment on this. I know you're both in the process of working through new funds and facilities that should reflect some of these learnings. And so perhaps, Gustavo, if you could kick us off and share a little bit about how this is shifting or shaping your new facility, and then Steve will pass over to you as well.
Yeah, of course. Yeah, like you said, we are currently working on launching a new investment facility. We are still working on the final internal approvals. And just to provide a quick background, the CFC is financed by its member states, but we want to also attract the private capital. So that's what this new facility will aim to attract private capital to the type of companies we support. So we will keep the same focus that we have, and that was evolving over the years, but we find that this works, which is the value chain approach. So we invest in companies that help to increase the local value addition. So these are mostly processing companies that are working with smallholder farmers, but they are doing the processing locally. This is in developing countries. Also, we target also some least developed countries. So we see that these can increase the impact of our investments. And increasing the local value addition, we think will result in a more fair value chain. And this helps to protect the farmers and companies from price volatility, from market volatility. But as the world is changing and rebuilt from the impacts of COVID, we think that we may have the opportunity to maybe have more green initiatives, to have more tech components, for example, on the companies that we invest in. But to say maybe a concrete differences and examples for the new facility, we'll be targeting also this bigger ticket size. So for now, we offer up to 1.5 or in some cases $2 million US. So we'll increase the size. We are planning to increase the size to up to 5 million. And this is a response to market demand. So we have been receiving requests of bigger ticket size, and we think this will also help us to diversify our portfolio. And one learning that I can maybe share that would be interesting to share with you, it's our increased use of trade finance facilities. So this is a type, it's an instrument where we finance the exports of a company based on the buying contract. So you have a client which is buying the product from you, and we, the CFC, finance the gap between receiving the money and you send the product, which can be really long, could take months, and some cases almost a year. And this is more short-term capital, but we see this as a great opportunity for us to get to know more about the companies. So we build this relationship, we get to know more about the business and how the company works. And then if things go well, we can then commit to long-term capital. So in the end, this allows us to invest in maybe riskier companies because we have a safer collateral, that's this buying contract agreement. So this allows us to invest in companies that at least they have a higher perceived risk, and then build a relationship to maybe make longer commitments.
Thanks so much for that, Gustavo. And one thing I'll just reflect on is it's so interesting to hear all of these different ways that community perspective comes into your previous work, but also shaping the future work and really informing that strategy. Thinking about those different instruments, the core impacts and the systemic nature, thinking about that full value chain. And so there's a lot there that's really noteworthy in terms of this idea of embedding impact across the full process. Steve, would also love to hear you reflect on the same. And one thing I'll throw out to the audience in the meantime is we have about 10 more minutes for questions. And so if there's any other questions in your mind, this would be a great time to send those through and we'll see if we can weave them in. Steve, over to you.
Yeah, thank you. So as I listening to our fellow panel members, our firm has evolved significantly since we came up with this idea of going to market with a unique twist on a traditional leverage buyout style / private equity strategy that incorporates employee ownership. 10 years ago, when I met the folks that became my future partners, our approach was really, I would describe it as market driven. We felt that there was, like Amelie mentioned, a gap in her end markets. We felt there was a huge gap in the lack of employee ownership options for owners of businesses that were considering making a change. And we felt that the market would be responsive to that. We felt that was an opportunity to give the market something different. The good news is that that's been reinforced in almost every way possible. Our view of the opportunity for this strategy, not just our fund, but hopefully other managers as well, is significantly larger than we would have guessed 8 to 10 years ago. The market has been very, very receptive to this idea that owners of businesses can sell their companies to their employees without having to make any concessions, whether it be in value or it be in liquidity. And so we've evolved and tightened our view and our strategy over the past 4 or 5 years, so that really all we do today is focus 100% on executing these employee ownership or employee-owned buyout transactions. We as managers of the fund have also evolved. If you had mentioned the word impact to us 10 years ago, honestly, we would have not had any concept of what that meant. But fortunately for us, about 5 or 6 years ago, we had the opportunity to interface with some not-for-profit advocates for employee ownership, and it reinforced our view that, and our phrase is that capital is a catalyst, that a fund like ours or funds like ours are necessary if we're really going to drive significantly the penetration of employee ownership in privately held businesses in the United States. And so we have become more and more vocal and more active and focused on advocacy for employee ownership. And then I think the last piece of that puzzle is how we are interfacing with our portfolio companies post-investment. Obviously, we were focused in the first fund and acutely aware of the financial benefit that will be delivered to our employee owners if our businesses are successful. But we've expanded that view, and what we've really added to our strategy is what we would call more of a quality jobs initiative. So starting with our two most recent investments, we hire a third party to do an assessment of really sort of the human resources function within each of our businesses. You know, believe it or not, many of our businesses, when we become involved with them, do not even have a dedicated human resources manager. So we are trying to make an assessment of each of our businesses around their policies and their protocols and how they're supporting those policies. And our goal is that we're going to do an assessment for each of our business, and over the next 5 years of our involvement, try to bring them each of our companies up to some minimum level of acceptability, whether that be the fact that we didn't have before, but we will have going forward, a dedicated human resources professional, standardization around paid time off, standardization around maternity leave, standardization around healthcare benefits, a goal of over time increasing what the percentage of our healthcare benefit that our companies are paying relative to our employees, introduction of financial literacy resources so that our employee owners can have an appreciation for this benefit that an ESOP provides to them. So we as a firm have evolved in terms of our strategy, but we as managers of our firm have also evolved. And what we would envision is that you know, going forward in our future funds, the vast majority of the folks that are providing our capital will indeed come from the impact investing world. And what we believe that we can do is create significant impact, both social and financial, for our employee owners and do it in a non-concessionary way. And we believe that is a platform that can be scaled. And by scaling, you know, we're going to simply magnify and multiply the numbers of employee owners that we're going to create and that we're going to support.
Thank you so much for that, Steve. And I think this might be our final question before we share some closing reflections with the group. Amelie, this one is for you. And in a similar vein, this person's interested in hearing how the model has evolved, but in particular over the past year and a half in light of COVID, and how that may have influenced the ways that you're supporting investees and shaping your investments.
Thanks so much. That's a great question, and I have lots to say on this, but I'll try to keep it to my under 3 minute time allocation. So one way the model has evolved is by giving rise to this new returnable capital vehicle that I mentioned, GIF Growth, which we're hoping to launch at the end of this year, early next year, because we see the pioneer gap actually needs all different kinds of capital and needs investors who are willing to partner with businesses through that gap with follow-on funding rounds, et cetera. So we needed another vehicle to be able to do that. So that's a clear evolution of GIF strategy. With COVID, I mean, we, like many others, really focused on our portfolio during that time. We continued to make new investments, but we really doubled down on post-investment support to provide investors with enough flexibility, our investees with the flexibility they needed, again, to pivot their model, for not only because they're pivoting because they're innovators, but some of them needed to really pivot their models because of COVID-19. One example is an innovation focusing on mental health, depression in women in sub-Saharan Africa. It's a fantastic innovator called Strong Minds. They are a social enterprise that works across Africa. They had a model of in-person group therapy, which has some incredible outcomes from a mental health perspective. And for women, it has great potential outcomes for increases in agency as well. In March 2020, when COVID disrupted the delivery of their in-person sessions, with GIS support, the team rapidly transformed and launched a new group teletherapy model. Early results of that model are already promising. Over 80% of women are recovering, which is comparable to in-person therapy results. And alongside this, again, with our support and the support of other funders, they ran a public education radio and social media campaign in close collaboration with the Ministries of Health of Uganda and Zambia that reached over 16 million people, again, paving the way for future partnerships for the social enterprise as well. So with our post-investment support and the flexibility we're able to give them in our grant, we were able to give them the support they needed to really pivot their model because of the impact of COVID, and many other businesses I think were in a very similar position.
Thank you so much for that, Amelie. As we kind of wrap this all together, I first am just so grateful to be joined by three panelists, and have really been impressed by the breadth that this group covers. We have really straddled the asset class spectrum. We have folks that are focused on capital preservation all the way through market rate returns. We're talking about really different strategies that are all anchored around that same goal of embedding that systemic change, that depth of social impact that's really meant to last and to transform. And so what I'd love to do is as part of our close today, just invite each of our three speakers to share a minute or two of advice for those on the line. And for this, we have investors and investees on the line. And so if there's anything you would share for either perspective in terms of how to just think about this impact integration across the investment process, that would be fantastic. And so we'll go in the same order that we started with today. And Gustavo, I'll invite you to kick us off, followed by Amelie and Steve.
Okay, great. So I'm an impact officer, so I'm responsible to manage the impact of the CFC. And I'm glad to see that the sector has evolved a lot in the past few years. So I think the impact management practice has improved, and we are seeing more standards, more initiatives, and I'm glad to recognize. But on the other hand, I think that we still need much more. We still need better system. We still need to improve the way we manage impact. If we want impact investment to be part of mainstream investment. And I think this is an issue that concerns all stakeholders. So the funds, impact professionals like me, academia, companies, but also the investors. And so if I can make an advice or a request is to please ask more details, more information, more clarity, more transparency on the impact of your investments, because managers do respond to market demands. So I think it's also the role of the investors to ask for more. So that would be my final remarks.
Thanks, Gustavo.
I'm going to stick with that impact theme and mention something that GIF and I am particularly passionate about. So as investors, and I think as investees, let's check every investment in business for its impact on women and girls. This is both possible and practical and will really increase inclusion. It's difficult, but measuring social impact, as Gustavo has mentioned, is hard, but we've been working on it GIF for a few years. Many others have as well. And we're just starting to develop ways to really measure gender impact by both quantifying the benefits of reducing violence against women and girls and by quantifying the benefits of increasing the agency of women and girls in it alongside other gender impacts. Much more is needed. We have more information on our website. I'd be happy to connect our team with anyone interested in this topic, but I think it's really a call to action. So let's get together and really start tangibly measuring the impacts on women and girls of our investments.
Wonderful. Thanks so much, Amelie. And we'll drop a link to your website in the chat for folks that are interested in following up. Steve, over to you.
Yeah, so I guess as opposed to advice, I guess mine is more of a request, really aimed primarily at the folks, our participants today that maybe represent investors into various asset classes, which is to be open-minded and spend the time to understand the impact that employee ownership can have on working class Americans. We've proven it in terms of our own investment processes there is significant academic research over decades which demonstrates the tangible and significant value that employee ownership can create for employee owners across America. We think the numbers of employee owners is woefully short. We are advocates for trying to build that. And a way for us to do that is to get access to more and more investors who are looking through an ESG lens, but would be open to the idea of trying to understand how impactful employee ownership can be. And so we believe that is, if we're going to achieve our goal of dramatically increasing the penetration rate of employee ownership across our target market, which is the United States, we need support from investors that will give us the capital, to be that catalyst. And so ask the folks attending it today to be, if you are looking through a lens of where to invest capital, think about as employee ownership really being a component of your ESG strategy.
Wonderful, thank you, Steve. And I'll just briefly close us with a couple of reflections, pulling this conversation together. What I'm really taking away is 4 C's. I'm hearing a lot about community, and really weaving that community perspective in from start to finish. We've touched on that from due diligence to investment management to exit. Second, we're hearing a lot about compassion and how to bring those stakeholders' perspectives directly into the conversation, how to keep them central, and how to really listen to those needs. And that's come through each speaker's approach today. Third, I've heard a lot about cooperation, and we've heard examples of working with local governments, with local partners, with technical experts and support providers along the way, and with other investors, including through this call to action that we've heard just now. So a real need for that ongoing cooperation and coordination. And then lastly, we've heard so much about the need for ongoing curiosity. And I think, Gustavo, you captured this so well in your reflections on that feedback loop, and the need to keep learning and asking and exploring and connecting with each other. And so we're just so grateful that you've joined us for this hour, and for the rest of today's virtual event, and hope that you stay on the line. We'll be transitioning out of our breakout and back into the main session in just a moment. But with that, I do really want to thank Steve, Gustavo, Amelie so much for sharing your perspective, but also just the really valuable work that you do day to day. And to everyone else on the line, thank you so much for the gift of time, and for joining us, and your ongoing curiosity as well. It's been a real treat to have this conversation. And so with that, we will close and turn back to our main session, and hope that you'll stay tuned for the rest of the segment of today's series. So thank you all so much.